All right, so let's take a look at annuities. Let me share my screen. All right, so basically what we're going to cover today is everything annuities. We won't go into each individual annuity on this training, but we're going to just do kind of a high level overview. And so we'll talk about what an annuity is, how to find opportunities, how to present, what it's not, compare it to an IUL. So it'll be pretty comprehensive. All right, so so let me go back actually. So the first thing is that if you haven't done this already, you really do need to go to fflams.com and get registered. That's the first thing. Once you do that, you'll be able to see where you stand as far as annuities that you've completed with FFL, with the different carriers, and they also keep track of that because your contract level is also dependent on how many annuities and what the amount was over the lifetime you've been with the company. So as you place people in annuities over a certain amount of time, your contract level will go up based on that. Oh, why is it not changing? All right. So the first thing, what is an annuity? So basically what an annuity is just a contract between the client and the company where the client is saying they're going to leave the money in for a certain amount of time. The company is saying, okay, well, if you pull it out before, you can pull out a certain amount. If you pull out more than that, there's a penalty. And these are the bonuses and things that you're going to get by putting your money here. It's also meant to be long-term savings. So sometimes people will try to pitch it as if it's an investment where the money's a lot of liquid or is liquid. It is not. It is not meant to be. It is meant to stay in there long term, which is one of the reasons why they can offer bonuses and things like that, and give such high rewards, because what they do is they take that money and then they use it for investments and things, and that's how they have the guarantees that they have available. So they can include guaranteed growth. Those are with the fixed annuities. Some of the indexes do as well. They have a guaranteed amount, and then the part that you actually present what could happen historically. And then some also include a guaranteed income. And this is an insurance product. Sometimes people think that annuities is its own thing. It's still an insurance product. The only difference is they don't have to go through a medical exam for it. So there are several reasons why someone would pick an annuity. A lot of the ones, especially the ones that I've been working with lately, they're using it to protect their money in retirement. So they're already retired. They have money in a 401k or something. They're seeing that they're losing money on a consistent basis and they want to stop the bleeding. And so they move it into an annuity, either that's going to pay them a guaranteed income moving forward, or sometimes they just don't need to touch it and all they want to do is take out the RMDs. Which is required at 72, I think it just moved to. So, or 71, 72. I'll have to look that up again. But they pull out the amount the government requires so that they get taxed on that. They have to do it. But the rest they just want to leave there so that it's guaranteed to still be there and they can stop losing money as the market goes down. Like I said, they do have guaranteed income. And then it does have stable growth in the sense that it has no losses. So you can do fixed annuities, which are about 4% or so. But even with the fixed index annuities, there's no threat of loss at all. There's going to be a guaranteed amount. Sometimes it's, 0.5, sometimes it's 1%. And then it's going to do whatever the market does at that point. And another reason that someone can go with an annuity is because they can't qualify for life policies. So if somebody wants to put money away, they want to put it into a place where it's going to grow, they don't want to lose money, kind of like an IUL, but they don't qualify for that, you can go ahead and put them into an annuity, because there are some companies that allow you to continue to put money into it the same way you would like a 401k, except that money at the end of the day is after tax dollars. And on top of that, there's no losses like you normally would have with the 401k. And then sometimes they just can't afford life policies and all they want is the growth portion without the life. Also, the fees are lower. So in 401ks, usually the fees run anywhere from 2% to 5%. Once people know that, a lot of times they'll want to move their money. It's one of the first things that I bring up when I'm talking to them and they say they have a 401k and I'm thinking about moving them into an annuity is, hey, did you know that you're paying 2 to 5% in fees every year? And that's regardless of if you gain money or lose money. So when you're losing money, you're losing twice. You're losing, off the principal, and then you're also paying the fees to your advisors as well. And then protection from probate. So this is extremely important because with 401ks and things like that, unless there's a clear-cut will, even sometimes then it can be contested. It can end up in court. When they put something into annuity, they pick a beneficiary, and that's where the money goes, period. There's no probate, there's nothing like that. So a lot of people, especially the wealthy, will put their money into annuities so that they can dictate who's going to get the money, who the contingents are, and it never has to go through probate. They don't need a lawyer or anything like that for it because those types of estate lawyers and things like that can be pricey. And then some also offer premium bonuses. And so we'll compare the annuities and the IUL. So with annuities, there's no medical exam at all. There's a suitability that they have to go through. And basically what that is, because I didn't include this in the training, but I should have, is what the companies want to do is make sure that the person isn't overextended. So if they have, $100,000 net worth and they're trying to put in $100,000, they're going to say no, because their goal is so that the person keeps it long term and never has to pull it out if there's an emergency. And so that's kind of how that works. With an IUL, there is a medical exam. With annuities, there's fixed or index growth. Same thing with an IUL. You don't have to necessarily do the indexes. You can do a fixed version of it, and then it just pays out a certain amount guaranteed. Annuities give a guaranteed lifetime income. IULs do not. Now, I know people preach that, but it is not true. It is not guaranteed. Because if the market goes down while the person is pulling out money, or let's say there's continuous years where there's no growth, or the person pulls out more than they're supposed to, or they have an emergency, or the person has to use their living benefits, there's a lot of things that can happen where there is no guaranteed income. So selling it as something that's a guaranteed income is not true. You should not do that. You should not say that this is guaranteed, because even when you're illustrating an IUL, what's showing up there is not necessarily going to happen. And in all honesty, most IULs do not perform as illustrated. So you should not say that. You can say this is a possibility if the market continues doing what it did in the past. This is what you could have. But you should never at any time say, okay, yeah, this is going to give you a guaranteed lifetime income, because it's not true. All right, both offer death benefits, both offer protection from probate, both offer protection from losses. Now, with the IUL and with the annuity, it can be nuanced. With the annuities, there are ways where you can do things in fees where if it takes zeros in the market for several years, I guess technically there might be a loss, a slight one. With an IUL, it could be quite a bit higher because there are insurance costs and fees and things, administrative fees thrown in there. So if there are a bunch of zeros, then you could potentially see that cash value start to go down. It's just something to be mindful of. But there is protection from it over a long-term scale, so it is safe to say that. There's no insurance expense with the annuity. There is an insurance expense with the IUL, like I just said. And then the annuities have low or no fees, and the IUL does have administrative fees. So what you'll see is that with the IUL is illustrated, it will grow faster than the annuity, but there are some other fees that are thrown in there as well. And then again, over the long term, when you look at the IUL's performance, and me and Matt actually did take a look at the IULs that we wrote back in the day and how they perform versus how we illustrated them, and it doesn't work. Because one of the other things with the IUL that you have to be mindful of is sometimes people write them in a way where they're supposed to put in more money down the road and they never do it. And so that causes some issues sometimes too. But we'll get into that when we talk more about IULs.
That happened to my boyfriend.
Yep. It does happen. We may want to talk to him at some point about maybe switching over to like an IBC policy or something. But we'll talk about that another day. All right. So here are the pros. So The pros with an annuity is there's low or zero fees, protection from losses, protection from probate, and then survivor spouse benefits. So this is really great if you do have, if you're married, you can actually add the spouse onto the policy, and all of that money will then go ahead and transfer to them if you pass away. So I like these a lot better than even pensions, because with a pension, normally you have to select how much of the money is going to go to the spouse ahead of time. And then if you pass away, the spouse gets that portion of it, and then that's it. Here, with the policies, you put the spouse in at the very beginning, and what happens is you have a guaranteed income. If you pass away, then it just moves over directly to the spouse, or if there's just a lump sum in there, the whole lump sum passes over to your spouse. And then bonuses. This is my favorite thing, because right now, Athene has a product that has a 20% bonus just for moving the money over. And then as you do it for less and less years, it drops to, I think, like 16% and then like 10% or something like that. But those bonuses are great. It's very basically to attract people there when interest rates are really high. That's when you'll see the bonuses go really high. And then when they go low, that's when those bonuses shift. So like right now is the perfect time to pitch as many annuities as you can, because people will get the highest bonuses right now while the interest rates are so high. And then, of course, you can participate in market gains, and there's no contribution limits. Now, I did talk to Athene recently, and if you are trying to move over $2 million, they do have to go through special approval, but there's not a limit like there is with like a Roth IRA or an IRA or things like, or mainly it's Roths where they have the limits on how much you can put in. There's no contribution limits with annuities. Some of the cons is lack of liquidity. So usually what ends up happening is there's a surrender period. We'll talk about that later. And so you can take out a portion of it, but if you take out the whole amount, then you're penalized for that. But it's no different than a 401k in that sense. There is limited growth. So even with with a lot of the indexes, there are caps and things on that, because they do have to mitigate, how much growth you get, especially since you're not taking any losses. But that's pretty much the only thing. Misconceptions. So I actually had a talk. I started realizing all the misconceptions about annuities when I had a talk with my best friend, actually. And he was telling me things where I was like, where are you getting this from? And I actually went online and looked it up. And it does say this stuff that's old. Like back in the day, it used to be like that. But a lot of annuities have changed with the times. And so a lot of the issues that our grandparents had with annuities are just not the case anymore. So one of the biggest ones is you lose your premium when you're getting the guaranteed lifetime income. That is no longer true. It's called annuitization. You can do that. Please do not do that to any of your clients. That's just mean. You do have riders like the guaranteed income riders on the Athene. I think it's the Agility product, where basically what happens is you get a guaranteed income. As you do that, the money in the account gets lower and lower. If you pass away before that amount hits zero, then that money passes on as a death benefit to your loved ones. If you live past that, then it's going to continue to pay out regardless. If you ever want to go into a training about why they're able to do that, it has to do with the mortality table and things like that. We can save that for another training, because that's a little bit more technical. So if you guys do want to get in the technical side of things, I can do that, but it'll probably be on a much smaller basis. All right, some people say the fees are high. Now, if you ever hear this in the field, my question right away is, compared to what? Because if somebody makes a statement like that, they're usually, thinking that there's administrative fees and things like that. With Athene, I think I saw a 0.95% fee, depending, and then there's certain fees where you pay but there's always a benefit that goes with that fee, either more liquidity, a bonus. There's something that goes to that. When they say, okay, well, there's fees. Okay, well, there's fees in your 401k too. Do you know how much those fees are? They're between 2 and 5%, whether you gain or lose money. And what do you get for it? Nothing, because the managers, what they don't realize about 401ks and even mutual funds and things like that is For one, you have somebody that is just taking a cut of your money regardless. The other thing is they don't really offer you any protection, because in most cases, if you're investing less than $1 million, it's not being actively managed. It's just thrown in a fund and just left. And so a lot of times people don't realize that. That you pay more in taxes, that is absolutely not true. Now, once you take the income, you can end up paying more in taxes, depending on what your social security level is and things like that. But really, that just means that you have more money coming in. And it depends on if you're taking the guaranteed lifetime income or pulling it all out at once. Sometimes people think that at the end of the annuity, you have to pull it all out at once. That's not true. All you have to do is, at that point, there just means there's no surrender fee. You can pull out as much as you want to without penalty, but you do still have to pay the taxes. And they think that annuities can be complex. They're not. I don't know where this misconception comes from. They're not complicated at all. They have a surrender period. They have an amount that you can take out without penalty. And then after that, it's kind of based off of the way that you set it up, but it's not complex. And one way that you can combat that, if somebody does say that, is, okay, explain to me how the inside of your 401k works. I'll wait. No one's ever going to be able to tell you that. I've not yet ran into a person that can tell me where their money's invested, what it's based off of. If they say like, oh, it's low risk. Okay, so what stocks is it invested in? What mutual funds? They have no idea. Okay, so what fees are attached to what? They have no idea. Who's the one that's managing your 401k? They have no idea. So it's not complex at all. It's just a lot of times these fund managers and people like common knowledge, popular belief, whatever, they will say these things so that people do not move their money out of these dangerous 401ks and mutual funds into the annuities. All right, so let's look at the type. So there's fixed index annuities. Basically, those are typically going to be about 4%. MYGAs are multi-year guaranteed annuities. They're kind of like CDs, where there's a certain amount of money in there and they say at the end of the term, we're going to give you X amount of dollars. And usually they just perform better than CDs. Then there's the index annuities, which we're more familiar with. And then there's the variable annuities. For the variable annuities, you do have to have, I think it's a Series 6 at least, license to do a variable annuity. It's just like how variable universal life policies are, where it's tied to the index. And if the market goes down, you can lose money. It acts almost exactly like a 401k does in that respect, but it can still have the guaranteed income and things down the road as well. Still avoids probate, all of those things. But the way the money grows is directly tied with the market. So the amount in the annuity can go down if the market drops. And then there's single pay annuities. So like with the performance elite products, I think with the agility, it's this way too, where basically they move a large sum of money in and that's it. They cannot contribute to it anymore. Some will allow you in year one to put more money in, but after that first year, they won't. And then there's multi-pay annuities. The one company that I know that I've used this before with is National Life Group. They do have annuities built specifically for seniors, for younger people as well, where they can just put money in. And this is what I'll typically do if somebody's looking to save for retirement, but they cannot get a life policy because of health reasons. All right, so qualified versus non-qualified. All right, so this is really, really important because you can't mix money. We'll get into that in a minute. But basically what qualified means is it's before taxes. So when you're looking at qualified plans, we're talking about IRAs, 401ks, 403bs, TSAs, or pensions. I think I actually meant TSPs. So TSPs, pensions, those types of things where they pull the money out before it's taxed. Non-qualified means after taxes, so cash or like anything in a bank account, Roth IRAs, Roth 401ks, all these things are after taxes. And you cannot mix qualified with non-qualified funds. So let's say that somebody has a 401k and then they have $200,000 in the bank. they want to move their 401k, and they want to move $100,000 into an annuity. They would have to have two separate annuities. They could be the same product, but one is going to be listed as qualified, the stuff coming from the 401k. The other one is going to be non-qualified, and that's where the money from the bank account is going to go to. And so now there's ways to fund. So there's a direct transfer. You can actually fill out a form where Athene will send a request directly to the company, and the company will send the money directly over. There's an indirect transfer where basically what happens is, let's say that I have one with one of the fund companies, the 401k or whatever it is. They will send the money to the client, and the client mails the check directly to Athene or whichever company that you're using. They can write a check. If it's in a bank account, they can write a check and send that check in. Cashier's check is usually the best way to go. And this is new. I did not know this was a thing until recently, is you can do a transfer directly from the bank with Athene. I did not know that. All you needed to do is have their bank account number, their routing number, and then like a deposit slip or something, just something that they can verify that the numbers are correct. And then they will go ahead and pull the money directly from the account. Boom, it funds, good to go. So if you have anyone that has a bank account that just wants to move that money into an annuity for some reason, and usually that's going to be that they can't qualify for a life product, because it would be better to move it into like a whole life or an IUL, they can still take advantage of that. All right. So surrender schedules. So it's just going to depend on the length of the contract, and the penalties do decrease over time. Any amount over the allowed is penalty free, or any amount over the allowed penalty free withdrawal amount is subject to penalty. So basically that means, like, let's say they can pull out 10% and they pull out 15%. The first 10% is going to be penalty free. The other 5% would be penalty free. And that's just a quick view of what that looks like in a 10-year. This was a 10-year with the Performance Elite. And then also one thing I wanted to bring up is the premium bonus vesting charge. So basically what this means is that when they get the premium bonus, they will not see that, like if they withdraw all of their money from the account, they will not get the premium bonus here until year 7, and only 20% of it. Then it goes up 40, 60, 80. And then after they finish their contract, that's when they get the full 20%. So they do need to leave their money in there. They can't just put the money in and take it out year 4 and expect to get the bonus. That's not how it works. But the main thing is to look here, and you can see the withdrawal charge starts off at 12% and then tapers off until the contract is ended, because this is a 10-year. All right, so how to choose an index. All right, so here's the thing about indexes. This is probably something that you guys will want to write down or memorize, whichever. Is all indexes have good years and bad years. All of them. There is no best index. Like, I think the S&P probably is the most stable, but even that has some bad years. And so it's good to diversify the indexes. Now, depending on who you talk to, they're going to tell you, oh, use the S&P, use this, use that. Do not do that. Separate it out. Like, what I do is I choose 4 of the indexes, and I put 25% in each. It'll do 2 things. One, the illustration is going to look a lot better because it's based off of what each of these indexes did over the past 10, 15, 20 years. So where one index might have done really bad, another one might have done really well, vice versa. But it also gives a nice mix. So the chances of the annuity actually, and this is with IULs too, but the chances of it actually performing the way that you're illustrating it is a lot higher, because the person won't be taking zeros constantly, because it's almost impossible for the entire market to take a loss. Usually one will go down, one will go up, one will go down, one will go up a little bit slightly. Sometimes all but one will go up. Like, it depends, but it's good to mix those up. And usually I just do 25% in 4 different ones. And again, it just prevents the client from taking zeros any given year. And the main thing is no one can predict this with any certainty. So why would you put all your eggs in one basket? You might as well break them up. And then the more participation, the more risk when you're choosing the indexes. So some have, 90% participation rates, 85% participation rates. The reason for that is because they're less risky. When they do have more participation rates, like the 140s, 160s, 200, usually what that means is that, yeah, they can get really big gains, but the chance of that person taking a zero that year are pretty high too, because the market goes up and down in those particular cases. All right, so now finding opportunities. All right, so now you everybody here kind of knows what an annuity is, how they work, more or less. We'll do an example in a little bit. All right, so basically finding an opportunity, it can be found with any lead type. It does not matter what the lead type is. I've sold annuities off of final expense, mortgage protection. It does not matter. You'd be surprised. So one of the things that's really important to do when you're first starting out, like when you're first talking to someone, is explain to them what you do. It's not just, hey, I'm here to talk to you about your final expenses that cover illness, injury, and your final expense costs and things like that. Or I'm here to talk to you about the mortgage protection lead and leave it at that. That's like leaving, food on the table, meat on the bone, because there could be something that you do that they're also interested in. So me personally, I say, all right, great. So besides just, final expense or life insurance, I also specialize in retirement protection, asset protection, retirement planning, health insurance. Now I name off all the different things that we do. And then I just tell them, if you have any questions about any of those things, let me know. If you want to get into more detail about it, you can say things like, oh yeah, I help people move over their 401k so they don't take losses, because I know that's a big problem for people these days. There's a lot of things that you can say or do to create those opportunities. And then this is a must. You have to do this on every single call. If you're not doing it, I don't know. Like, you know what? I do know. I do know. So a lot of reasons that people will not ask this question is because they don't know what annuities are. They're not comfortable with them. And so they don't ask this question because that's what it leads to. But I say ask the question anyway, and then get the information that you need, and then talk to your leader, and I'll go through kind of what you need to do for that. So the golden question is, what do you have that would act like life insurance that you could leave behind if something happened to you? 401ks, IRAs, mutual funds, significant savings, CDs, etc. Then the next question is, how much of that can you afford to lose? This is a very, very good question. Now, when the market was going up, it was still a good question, but now is the best question of all, because people are saying, hey, well, I've already lost like 20%, or I've already lost $10,000, $20,000. I don't want to lose anymore. And then it's as simple as just telling them, like, okay, well, there are programs where you could move your money over into those types of accounts. They're still going to grow when the market goes up without you losing anymore, so that you can protect your retirement. Is that something you're interested in me coming back and showing you in a few days? Yes. Okay. And then what you do is you can schedule it out for 2-3 days, and then get with your leader, ask a specialist, and then they can work or put that together for you. The other thing here is going to be, how much of that is protected if the market drops? It's a softer version of the previous question. And sometimes I call this the bronze question, because then they'll start thinking like, oh, well, there's ways to protect it. Like sometimes you can offer it back to back. Like you can say the first one, and then how much of that can you afford to lose? Oh, well, I can't afford to lose any of it. Okay, so how much of that is protected if the market drops? It's a good progression. And then after that, you can start having a conversation. All right, so how to present the annuity. If it clicks. All right. So there's a couple of things I do want to bring up. So you want to get with a leader when you're putting it together, or go to ask a specialist, or you can also call the company directly and they can help you put together a plan. So the full FIA, or fixed index annuity, SOP, is basically standard operating procedure. It's located in the Breakfast Club folder. You can pull it up and it shows you everything in detail. It basically is, oops, went too far. All right. So it's basically here. Bam. FIASOP.docs, whatever. It's inside of the folder, the Breakfast Club folder, under scripts. But we will go through part of it right now. All right, so when you're presenting, all right, so this is what I do when I present. So after I've got everything down, I get them on the phone, I send them the brochure. So usually I'll have the email already ready. And once they pick up, I'm like, hey, I'm gonna shoot you an email with a brochure of what we're about to go through. I'm not gonna go over it word for word, but this is something for you to have so that when we're done talking, while we wait for approval and all of that and to get everything transferred over, you have something that you can look at. And so in the email, it'll have the attachment to the brochure. It'll have the tables of the non-guaranteed values, and then it'll have a table of the surrender fees. So kind of what I showed you guys before. And then I just take, when I run the illustration, I just do a screenshot of the non-guaranteed values and put them there as well, because I'm going to be referencing them as we're talking. And this is just if you're doing it over the phone. If you're in person, you can just show them this and it's fine. And then have the client write down the name of the company and the name of the product, and also have them write down the following category amount. So I do it a lot like I do with my final expense and mortgage protection. So I'll have them write down the approximate amount they're looking to transfer, the length of the contract or withdrawal fee, the bonus, if it's applicable, liquidity. So I'll explain to them the non-fee withdrawal amounts, because sometimes it'll be 10% all the way across. Sometimes if they didn't take anything out the year before, it'll be 20% moving on. So I explain that to them. And then also return of premium if applicable, because sometimes they will allow you after year 4 to pull the full amount out of the policy. And this is just the premium amount, not any gains, without any penalty at all. And then growth. So I'll explain the indexes and how it works. Now, I don't get into detail about it. I just say like, okay, well, if the market goes up, then you get a percentage of that. If the market goes down, then you don't lose money. That's all I really explain to them. And then I do go over any caps, the maximum and the minimum. So if there's a cap on what the minimum is, like let's say it's 0.5% or 0.1%, I'll let them know like, hey, this one has a 0.5% cap on the downside, so you don't have to worry about that. You won't take it zero in these particular cases. And then the max that it'll pay out in this particular is 11.25 or whatever the case is on that. That way you're setting the proper expectations. And then you'll want to go over non-guaranteed amounts as well. And this is all based on, when they will retire, their income, etc. And so usually what I'll do is I'll just ask them when are they looking to retire, whatever the case may be, and I'll just show them, okay, well, at that age, this is how much money you'll have. If you have guaranteed, one of the ones with the guaranteed income, you would show that, of course. And that's just something that you'll want to get with your leader on how to present that part. So then you submit the application. Well, one of the things you should go over first is go over the process of transferring. And a lot of times what you'll end up needing to do is find out what company is, call the company and ask them what the transfer process is, and then get back with the client and let them know what the transfer process is, and then you'll work on that together. You submit the application and then you monitor it until the approval is done. All right, so that's that part. So pretty quick, straightforward. What I was gonna do, too bad Felicia didn't stay on, but what I was gonna do is show you guys what it looks like to actually build an annuity. So I am going to do that now. Give me just a minute. Oh, Nalene's coming on. All right, so let me get into it. Good morning, Nalene. You missed the presentation, but you get to see the demonstration, so I guess it works out.
Sorry. Got home late after work.
Fine, it is fine. This will be recorded, but I'll only tell you, Willow, and Felicia where it is. So
Okay.
you guys will be the only ones that get the link. The others don't. Nobody
Yay.
said anything, so
Mm,
not my fault, not my problem.
yeah.
I'm working, I was talking to Willow and Felicia about this too, is hey, you know, we're gonna be going through some mindset stuff on here. And at this point, the way I look at it is I only wanna work with people that want it. Like I'm not pulling teeth, I'm not, you know, trying to get anybody to do anything. Like, hey, if you really
Yeah.
want to go for it and you can make it happen, let's do it. If not, hey, because the bare minimum is say I can't make it because whatever. Like Yolanda, I already
Yeah.
know Yolanda ain't coming back for a minute. She just went through surgery. We had a long talk about that. She's cool. She's good.
Oh,
But like you know, some of the others, like, okay, you couldn't just say, hey, I'm not gonna be able to
won't
make
be
it.
able to make
You
it.
know, I guess it's not that important to you. Remove from the list. Moving on. Best of luck to you. All right. So anyway, enough of my crazy rants. I will make sure I cut that out of the video. Probably not. I'll probably leave it in there.
Leave it in
All right.
there anyway.
Yep. All right. So once you log into a theme, when you do the application, you'll click on Firelight e-services, but you're just going to click on run an illustration. All right. And I'm just going to do it for the Performance Elite. So
Okay.
to the illustration center, I really should. We'll go through a training at some point on how to do each one. I wish we could all get together in person and then kind of work on it together. That was so much fun.
Yeah.
Dave, remember that, Nalene? Oh,
Yes, the good old days.
good old days. So we get together like, all right, hey everybody, I'm gonna be going
Yeah.
through this training day. We would go into our rooms and like everybody would ask questions.
Yeah.
I kind of miss that. I think I need to go in the office again because I think I've spent too much alone time. I think I need.
Ah,
I
come
need
to
to
the
do it.
office.
All right. And so the one that I like to offer is the Performance Elite Plus. What I do encourage all of you to do though is to go into a
Mm,
theme once you're
mhm.
contracted with them and get all the brochures and read through them.
Okay.
I would encourage you to do that honestly with all of the products because Nalene, I don't think you weren't. I had been with the old company for a while before you came on, and this is how
Mhm.
seriously I take things, guys. Matt thought I was crazy when I first started. So
Mhm.
I went in and he was like, what are you doing? Because I wasn't really talking to him or anything for about 2 weeks. And I told him, like, oh, I'm going through all of the companies and I'm reading all of the brochures and all of the highlights from each product. And he was like, why are you doing that? And I was like, how am I supposed to offer the best product if I don't know what they are? And he was like, well,
Mm.
okay, then you do that. And then down the road, it's like, hey, can you train people on this and that? Yeah, because I did the work. And so you kind of got to look
Makes
at that
sense.
too, because the less you know, the higher the potential for harming your client is. And so
That's
you
true.
want to make sure that you know as much as possible. And if that's not a focus of yours, I really would um think about like, well, why are you even doing this? Is it just for the money? Like you just don't really care about people and you just want to get money as quick as you can? If that's what you, then nothing I can say about that. But if
Mhm.
you're here to genuinely help people, then why wouldn't you put in the work to really help them? Like you work in a hospital, Nalene. Like what if the doctor just phoned it in? Like, oh, okay, you know what? I could go to this training on how to perform this new operation,
Mm.
but then I gotta wake
But
up
don't
at
have
7
to.
o'clock, and then I
Yeah.
got, I have dinner, I have my kids, I can't make it to that. So, my patients, they gonna have to go with the old one. I know there's a 70% chance that something could go wrong with the old one versus 30%, but 70% is
We'll
not
try
that
it.
bad. It's
It's
okay.
not too bad.
Yeah, they're rolling the dice,
Yeah.
but it'll be all right. I got insurance that'll cover me in case something goes wrong.
In case something happened.
That is horrible. All
Yes,
right.
it is. That's true.
So let's go Arizona. I need to move this thing out of the way. There it goes. Okay. Arizona. All right. And then we're going to go with the Performance Elite Plus. We're going to
Okay.
do test person. And we'll just leave all this the same because honestly, this does not make any difference unless you're
Mhm.
doing the agility because it has the guaranteed income.
Okay.
It does make a difference though when you're annuitizing sometimes, I think. But
Okay.
it doesn't really make that big a deal. But for the actual illustration, it's just so that it can show like at year this, what the values are, but it doesn't really change how it performs. All right,
Okay.
so in this one, we're doing a non-qualified. If it was a 401k or something, it would be qualified. The annuitant is this person. If there was a joint annuitant, we will put them on here. So this is where we would put the spouse, and it's just under
Okay.
client.
I don't see your screen. The screen
Oh,
I'm
you know
seeing,
what?
it's the one, it's the,
Let me reshare. Give me just a second.
okay.
Bum, 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 bum. All right, there we go.
Okay.
All right, now you can
Cool.
see it.
Yes. Thank you.
Okay, perfect. All right, so yeah, basically the way we got here is pretty easy. You just click on, well, let's just go back. I'll make it easy on you. We will start from here. Oh, let's go back to the very beginning. I did not know that you couldn't see it. So this is what it basically looks
Yeah.
like. This is where you'll see
Okay.
the different annuities that are currently waiting. Oops, forget you saw that. All right, and then we're gonna do run an illustration. I'll definitely
Okay.
have to cut that part out. All right, so annuity illustration center here. All right, so this is what I was talking about. So now we'll click the theme performance elite plus.
Mhm.
We'll do okay. Oh, let's do this to test client.
And then
88 is not what happened here? I don't know.
yeah, all of it get messed up, kind of.
There we go. All right.
Okay.
All right, test person in Colorado, but let's change it to Arizona.
Arizona.
All right, so qualified or non-qualified. Like I said, qualified, 401ks, things like that, non-qualified or that.
Okay.
All right, so we have client test person and the joint annuitant. Here is where we're going to put the spouse.
Okay.
All right, so now the policy details, this is where we're going to select if it's a 7-year, a 10-year, or a
10
15.
or 15.
The biggest premium bonus though is going to come from the 15-year. So you want
Okay.
the 10% bonus, you do that. Now, I didn't talk about this before, but I'll do it now. Is choosing the withdrawal charge period will depend on a lot of things. Not a lot, really just two. Every time I say a lot, it's not true. It's usually just a couple.
Not that much.
So it's going to depend on how old the person is. So obviously, if the
Okay.
person is 70, you're not going to put them in a 15-year. It'll probably be
Yeah, that's 7.
or if they are looking to need the money at some point in the future. So let's say that we have a 30-year-old that has a 3-year-old child or 2-year-old child or something like that. And they say, we want to put this money in an annuity so it can grow. And then we want to pull out the money to help pay for the kids' college. But in case they don't go to college or get a scholarship, we can use it for anything. 15 years is perfectly reasonable. Let's say that child is, 15. Then you may need to do a 7-year.
Yeah,
And so
makes
it'll
sense.
just depend on the client's needs, but usually if they have a long enough time frame, I'll do the 15 years. Sometimes I'll do the 10, depending on the age. I think the last couple that I did were 10 years.
Okay.
But we'll do 15 years just for giggles. Okay. So now we're going to look at the strategy options. So we have the fixed strategy, which is 100% is default. I back that out. And then
Okay.
I usually don't do the with charges. They're going to be higher, return rates and stuff like that. But I don't want to run the risk of the person taking a loss. So I just don't do it at all. Now, what you choose to do, again, is completely up to you, but this is just a personal preference. So I'm going to do 25% in the S&P.
Okay.
I'm going to do 20. Oh, wait, did I click the right one? Yeah. Okay.
Yeah, the S&P.
I'll do 25 here, 25
BNP.
here, and then 25 here.
Oh, okay.
So that's all I do. This AI powered index. I don't know, like for some reason it let me do it, but that's okay. I just put it in 4 different places that it equals 100 at the end.
Mm-hmm. Okay.
And then I'll kind of show you the difference between the two as well. All
Okay.
right.
Cool.
So next, you'll go into withdrawals. You don't need anything there. And then you just
Okay.
jump into reports. This is how easy this is.
Okay. Yeah, it's pretty easy.
Yeah, people think that it's really hard. It really is not. All right. So this is what it looks like. All right, where's the zoom in? Here we go.
It's done.
All right. So this is where you'll see what you're going to go over with them.
Okay.
Now, this I don't really go into with them at all, but you can see though that there's a cap and a minimum on the S&P 500. So sometimes I'll say like it does have a 0.5% cap, but I'm referring to this, but I'm not really explaining all of this because here's the thing is you don't want to over explain things to the client. This is just a general rule because if they're confused, they won't move forward with things. This stuff you don't need to worry about, don't need to worry about, don't need to worry about. Okay, so this is the guarantee contract values. We won't be looking at that because the thing that I want to point out is this, the non-guarantee contract value.
And now I don't see the screen anymore. Mine looks like blank.
Again? Let
Mm-hmm.
me see.
What's wrong?
Give me just
No,
a
it's from the Zoom. The screen is not showing.
Oh, it's because it jumped over to the illustration. So I was
Okay.
just going through this stuff.
was trying to
So
say
what I
something.
was showing was this. So when I talk about the 0.5% cap, it's with the S&P 500 point to point. Even though the rest don't have that, I don't necessarily explain it for each index because you don't want to confuse the client, because if they're confused, they won't move forward.
They won't buy.
Yep. And so let's say that the person here wants to retire at age 65.
Mhm.
And this is if they just put $100,000 in. We'll say at 65, they'll have about, this is the non-guaranteed, it'll be about 136.29.
Oh, you show them the non-guarantee one? That's the
Oh,
one you
this is
show
the
them?
guaranteed. Hold on. Wait, is this the guaranteed? Give me just a second.
Oh, I think
Yeah.
that's maybe
Let's
the
go into
guarantee.
the
That's not a
non-guaranteed.
lot.
I
Okay.
didn't scroll down far enough. All right, here it goes. All right. So at 64, 65 that year, it's 732,689.
Okay, that looks better.
I was like, man, that did not look right. All right.
Yeah, I was thinking like that's not exciting.
No, that's like, hey, at least I didn't lose any money. All right.
Yeah.
So at 65, well, yeah, at the year where they turn 65. Well, actually, let's go with the bottom one just because it's less confusing that way. All right.
Okay.
And I'll show you why I'm saying that in a minute. So 789, 944. All right. So just make a note of that number.
Mhm.
All right. And then we'll just scroll down a little bit more. And so this is usually the page actually where I will send them this. I'll just take a screenshot of this. I'll just box it out.
Okay.
And send that to them in the email. Going down, I don't really worry about any of that stuff. And then this is what I'll send them to, is so that they can understand what the surrender period.
Oh, the withdrawal. Okay.
So there's no, if they try to say like, oh, I didn't know down the road, like, nope, I sent them this. It was directly from the illustration. And so that's it. So one of the reasons that I wanted, the one reason that I wanted to show that is because now what I'm going to do is I'm going to jump back in. I'm going to share just my whole screen just to make life easy. Where did my Zoom go? There. All right. All right, this just makes my life easier. Okay, so now let's say that I do it the way that some people do, and they say, okay, well, we're just gonna put it all in the S&P, or all in one of the others, because that's just a better way. This is really
Yeah.
not, it's just they don't understand how it works, I guess. So
Yeah.
we will run the illustration, and then I'll show you the difference in the non-guaranteed values, what it shows, you know, between doing it with just the S&P 500. Because Marlene, you remember with the old company, they used to always tell us that use the S&P 500. It's the most reliable. It's the most stable.
Yes, that's
What's the most stable is not to have all of your money in one place.
in one place in case something happened. That's true.
Exactly. And that's again why it's so important. I don't know if you were on at the beginning, but it's so important to go in and log in to fflams.com, watch the videos there. They have weekly trainings on Saturdays where they teach you this stuff. I learned that from there. And even if your upline is saying like, oh, well, we can show you this and whatever, get knowledge from different places.
From
Don't
different
listen to
places.
just
That
one
makes
person.
sense.
Yeah, it's crazy. I used to be like that, where I would just listen like, oh, I'm going to listen to them. Nope. The reason I got to where I am now is because I listened to Matt, Julius. I watched Tom Hegna. I watched Doug Andrews. I watched Sean Ruggiano. I watch all this stuff, and then I take the information and then I fact check it. And
Makes
then I figured
sense.
out like, oh, because I'll run the values in illustrations and see which one is most right. And I'm like, oh, okay,
Yeah,
what they said was correct. And a lot of
makes
these
sense.
guys too, you have to keep this in mind, is a lot of the people that you can actually look at, read their books. I'm about to read Tom Hegna's book over the weekend. But they've been in the industry for 30 years. No offense to any of our upline, but they have not been doing it for 30 years.
Yeah,
Exclusively. Like that's exclusively what they do. They
what they've
go
been,
and they
yeah,
fly
sure.
around the country talking to people on these exact things. That's who I'm going to listen to. That's who I'm going to take my advice from. Because here's one other thing, Nalene, and I don't know how ambitious you are, quite honestly, but my goal is always to try to be better than the person that's training me at some point in time. That's how I work harder.
Yeah.
That's why I work harder. I refuse to follow behind Matt for the rest of my life.
But after I think 30 seconds
Can't
or
do it.
something,
It just
that
does not work out.
sign,
And so you'll just kind of
Yeah.
have to figure out, you know, how ambitious you want to be. If you're completely fine, you know, kind of part-time, don't really want to grow that big, and you know, just kind of want to be your sole producer type thing, and don't really care about, you know, growing it too big and making a ton of money, you don't have to worry about that. You're good. Don't worry about it at all. If on the other hand, you do want to grow, you do want to help more people, you do want to be the best agent you can be, your upline is only a standard in the respect that that's where you should try to hit first before you springboard and go even higher.
And go higher. Yeah.
All right. So look at this. The non-guaranteed contract values. If you just use the S&P 500, 6465, 474, 690.
Oh, wow. Okay. That's a big difference.
Exactly.
Oh, wow.
And that's why I don't illustrate or do S&P 500 anymore.
Okay. Makes sense.
Yep. Let's try
Do you do the same thing when you're doing IUL also?
Yep. I diversify it.
Okay.
Because if not, you are really, really screwing your client. So let's try another one. Let's do let's go this BNP. I think this is where it tries to put it sometimes. So let's just run a couple more, and then I will let you take the rest of your day because I'm going to try to eat. I had a tooth infection, so I'm taking medication for it. And so I'm so hungry. I'm like, all that's on my mind is
and you cannot eat much.
Eggs and chorizo.
It's like that when you can't have it, your brain is just focused on that.
It is. It is. All right, so let's see. Let's go through the non-guaranteed here. See, now this one is saying 931 215.
Oh, wow.
But here is the problem is you don't want to get into illustration wars with this because it is possible that it doesn't perform this way.
That's well. But will you do 50 instead of 25 maybe? Because it
Yeah, you
looks
can break
like
it up
that's
like
a
that.
projection.
Yep, you can do 50-50. Let's take a look at it. We might as well. We have some time.
Yeah. But that's a good way to see it.
Yep, this is what I do. And the reason I just broke it up like the way that I do is just because I just don't want to put all my eggs in one basket, basically.
Yeah, makes sense.
But the BNP, this is made up too, that by the way. That's why I also don't trust it.
Okay.
So here's what this means is that what a lot of these companies are doing is they are creating their own proprietary indexes so that they can boost their illustration number.
Oh,
So
okay.
because that's so high, I don't trust it, but I will
Okay.
break it down and include it in the mix just in case it actually does perform like that. But let's run a report based off of 50-50 mix. All right. Let's zoom in. So this puts it at about 826, 269.
826. It's still not bad
No,
from
and
6.
it's just really boosting the S&P 500. So,
Yes.
and here's the thing is you're looking at the chances. With me, with that BNP index, I just don't have faith in it. I'm just,
You don't have faith in it?
I just don't. I don't.
But at least I think the 25, it's pretty good, at least 25 in multiple places like that. You get more chances, I think.
Yeah. Yep. And there has been
That's a good
times where I've
idea.
done 50% in the S&P because I want it to be a more stable illustration. I wanted to get as close to that number as possible. And with the S&P, yes, it is the most stable. And with
That's
and
what I
so
learned.
here's the good part about what the guys were saying with the S&P is that if you illustrate it at the S&P 500, it's conservative and the odds of you hitting those numbers is pretty high. But if you could potentially get the person more money, then okay. And so that's where you're going to have to moderate their level of risk that they're accepting, that they're willing to take. If they're like, yeah, as long as I don't lose money, it's fine. I'm just, roll the dice, throw it all in the BNP, see what happens. Because it could have a lot of money or it could be fall anywhere.
Could be
But they're
falling
like,
too,
well,
yeah.
I just kind of want pretty steady growth. Okay, the S&P is the most stable one. We'll just put the majority of it there, and then we can kind of mix it up. And these are like little bit higher level type things. And that's what I want to do here at this point is make this more about let's really dial in and let's get you guys trained to the point where you know more than 90% of the FFL agents. Let's train you to that point. Let's make you superior agents because the way that I'm setting things up right now, I'll pretty much end this. So that's going to conclude the annuity part of this. So I'm just going to stop sharing and